smart money sold their bags on the S&P and it looks like we might be in for a little crash. According to the COT report, the net positioning by smart money on the S&P is now negative 173,000 plus. So that tells us that last week, smart money sold positions on the S&P. Bearing in mind, the S&P has really just been range bound since the start of this year. So we're looking at consolidation plus heavy smart money selling. And then if we also account for seasonality, February and March are very bearish for the S&P historically. And then we also layer on the fact that the EdgeFinder is giving the S&P a score of -6, which is bearish. So we've got economic data that's bearish, we've got COT positioning that's bearish, we've got seasonality that's bearish, and the market has done nothing. We are sideways. And now if we look at the behavior that the S&P follows, we can see down here, before we had the crash, we created a resistance that was then used to support. So now my question is, are we going to revisit this previous high before we had the tariff crash and use this as a level of support? Well, I think it's very possible, and this could be an absolutely massive trade if you're able to position properly. So what I'm looking for is a retest into these highs, and if we can see the market rejecting this level yet again and pushing lower, that would be my signal to then position into shorts. Now, I wouldn't be going heavy into this market because it's very, very difficult to short US markets like this. The natural drift is to the upside, so being a short seller generally will lose your money unless you can justify exactly why you expect this market to start crashing. And I think with all the things we've just mentioned, the reason might be starting to line up.